Welcome everyone. We are excited to present our group project on financial ratio analysis, PepsiCo versus Coca-Cola. This analysis will help us understand the financial strengths and weaknesses of these two beverage giants using key financial ratios. But before we dive in, let me introduce our team members and their contributions to this project. So first of all, I am Pratik. I'll be covering the introduction, industry overview, and company profiles for our project. I'll begin by giving you a brief overview of our analysis, explaining the importance of financial ratios, and discussing why we chose PepsiCo and Coca-Cola as our focus. I'll also provide insights into beverage industry, its key trends, and the financial benchmarks that help us evaluate these companies. Finally, I'll walk you through the background, mission, vision, and market presence of PepsiCo and Coca-Cola.
Hi everyone, I am Aneesh and my role in this project is to provide a comparative overview of financial statement of PepsiCo and Coca-Cola. I will analyze their income statement, balance sheet and cash flow statement to set the foundation of our ratio analysis. Additionally, I will introduce the four key types of financial ratios: profitability, liquidity, efficiency and leverage, and explain how these ratios help assess a company's financial health.
Hello, I'm Garima, and I'll be handling the profitability and liquidity analysis for PepsiCo and Coca-Cola. I will evaluate how well these companies generate profits using key ratios such as gross profit margin, operating profit margin, and return on equity. Then I'll move on to their liquidity ratios, which show how well they manage short term financial obligations. Through these comparisons, I'll help determine which company is more profitable and financially stable.
Hi, good morning, everyone. My topic is leverage analysis and efficiency analysis. To coverage these topics to grow the ratio of Coca-Cola and Pepsi, how the ratio is going on.
Hello everyone, I'm Sonu Panigrahi and I'll be covering the trend analysis and overall comparison of PepsiCo and Coca-Cola. I'll also examine how their financial performance has changed over time and identify important trends and patterns. After that, I'll provide a final comparison highlighting the strengths, weakness, and the financial stability of both companies. Finally, I will conclude with key takeaways and insights on which company is financially stronger and what the future may hold for both.
Together, we have analyzed multiple financial aspects of PepsiCo and Coca-Cola to provide a comprehensive comparison. Let's get started. So this is the table of contents which we are going to cover in this analysis. So today we will be conducting financial ratio analysis of two of the world's biggest beverage companies, PepsiCo and Coca-Cola. Our goal is to compare their financial performance using four key categories of financial ratio: profitability, liquidity, efficiency, and leverage. Why did we choose these two companies? Well, both PepsiCo and Coca-Cola dominate the global beverage market, making them ideal for comparison. They have similar product offerings, but different business models, which gives us deeper insights into their financial strengths and weaknesses. Throughout this presentation, we will analyze their financial health over different time periods, compare them against each other, and evaluate their performance against industry benchmarks. This will allow us to understand which company is financially stronger and what factors contribute to its success. By the end of this presentation, you will gain a clear picture of how these industry giants operate financially and which one has a better edge in the competitive market. The global beverage industry is a massive trillion-dollar market with soft drinks playing a major role in 2023. The industry was valued at over 1.5 trillion US dollars, with Coca-Cola and PepsiCo leading the soft drink sector. Coca-Cola controls around 45% of the soft drink market, while PepsiCo holds about 30%. However, the industry is changing rapidly. Consumer preferences are shifting away from traditional sugary sodas to healthier options, such as low-calorie drinks, energy drinks, and organic beverages. This shift has forced both Coca-Cola and PepsiCo to innovate and expand their product lines to cater to the growing demand for health-conscious products. Sustainability has also become a major focus. Companies are investing in eco-friendly packaging, reducing plastic waste, and cutting carbon emissions to align with government global environmental goals. This is not just a marketing strategy, but a necessity as governments and consumers demand more sustainable business practices. Lastly, economic factors like inflation and recession directly impact consumer spending when disposable income is low. Consumers may opt for cheaper private label brands or cut back on non-essential beverages. This makes financial stability and adaptability crucial for companies in this sector. Beyond current trends, let's talk about the future growth of beverage industry. Emerging markets, particularly in Asia and Africa, are becoming significant growth drivers as disposable income rises in these regions. There is increasing demand on branded beverages, opening up new revenue streams for Coca-Cola and PepsiCo. Another major area of growth is bottled water and functional beverages. With rising health concerns, consumers are opting for sports drinks, vitamin-infused water, and plant-based beverages. Both Coca-Cola and PepsiCo have invested in these segments, with brands like Dasani and Gatorade gaining popularity worldwide. Technology is also playing a crucial role in enhancing product efficiency and distribution networks. Automation, AI-driven supply chain management, and direct-to-consumer digital sales are improving profitability and helping companies reach more consumers efficiently. However, with growth comes challenges. Intense competition from regional brands is eating into market shares. Local beverage companies often understand consumer preferences better and offer products at lower prices. Additionally, private label brands like those from supermarket chains and gaining popular due to their affordability. Lastly, changing government regulations such as sugar taxes, health warnings, and plastic bans directly affect profitability. Companies need to continuously adapt to these evolving policies to stay competitive. Now let's dive into our first company, PepsiCo. Uh, it was founded in 1965 by celeb Bradham and has grown into a global powerhouse, generating an estimated 91 billion US dollars in annual revenue. What sets PepsiCo apart is its diversified business model. Unlike Coca-Cola, which primarily focus on beverages, PepsiCo has a strong presence in both the beverages and snack industries. Iconic brands like Lay's, Quaker, and Doritos contribute significantly to its revenue, making it less reliant on soft drink sales alone. This diversification gives PepsiCo a financial advantage, especially during economic downturns. When soft drinks sales decline, snack sales often remain stable, providing a more balanced revenue stream. With around 30% market share in the soft drink industry, PepsiCo remains a strong competitor to Coca-Cola, but its strategic mix of products gives it a unique edge. Moving on to Coca-Cola, one of the most iconic and longest standing brands in the world, founded in 1886 by Dr. John Pemberton, Coca-Cola has built a massive global empire, generating approximately 45 billion US dollars in annual revenue. Unlike PepsiCo, Coca-Cola focuses mostly entirely on beverages with brands like Coca-Cola, Sprite, Fanta, Dasani, and Minute Maid. It covers a wide spectrum of drinks, from sodas to juices and bottled water. Coca-Cola holds the largest market share in the soft drink industry with around 45%, making it the undisputed leader. Its strength lies in brand loyalty and an extensive global distribution network, ensuring its products are available in almost every country. Despite not having a snack segment like PepsiCo, Coca-Cola's strong brand identity, effective marketing, and deep market penetration keep it ahead in the beverage industry. Thank you. The next part will be covered by Anish.
Thank you, Pradeep. Good morning, everyone. Today, I will be comparing the financial performance of two of the biggest soft drink companies in the world, PepsiCo and Coca-Cola. These brands have been competing for decades, and their financial strategies have shaped their success. We will analyze their performance over the period from 2020 to 2023 by examining three key financial statements: the income statement, balance sheet, and cash flow. While both companies belong to beverage industry, their business models are quite different. PepsiCo has a diverse range of products, including snacks, while Coca-Cola primarily focuses on beverages. These different affect their financial performance, which we will explore in detail. So, an overview of financial statement. To understand how each company operates, we will analyze three main financial statements. First one, income statement. The statement provides details on how much money a company earns, the cost of running the business, and the final profit after business. Second one, balance sheet. This shows what the company owns, what it owes, and the value remaining for shareholders. Third one, cash flow statement. This explains how cash moves in and out of the business, including money earned from operations, investment, and financing. Now, move to next income statement. Next slide, income statement. Let's start by the comparing revenue, which is the total money a company earns from selling its products. PepsiCo saw its revenue grow from $70.37 billion in 2002 to $91.47 billion in 2023. Coca-Cola also experienced growth, increasing from $33.01 billion in 2020 to $45.75 billion in 2023. PepsiCo consistently earned more revenue than Coca-Cola because it sells not just beverages but also snacks like Lay's and Doritos. This diverse product range helps PepsiCo generate higher sales. Net income comparison. Now let's look at net income, which is the profit of a company net after all expenses, including tax and operation costs. PepsiCo's net income increased from $7.12 billion in 2020 to $9.07 billion in 2023. Coca-Cola's net income rose from $7.75 billion in 2020 to $10.71 billion in 2023. Even though PepsiCo makes more revenue, Coca-Cola is slightly more profitable relative to its revenue. This shows that Coca-Cola manages its costs very effectively, making more profit for every dollar it earns. Income statement operating expenses. Operating expenses include costs such as production, salaries, and marketing. PepsiCo's operating expenses increased from $60.29 billion in 2020 to $79.49 billion in 2023. Coca-Cola's operating expenses rose from $10.58 billion in 2020 to $15.93 billion in 2023. PepsiCo's expenses are much higher because it operates a larger business with both food and beverage division. Coca-Cola being more focused on beverages has lower overall cost. Now we are going to balance sheet. Next slide. Balance sheet. Balance. Now let's analyze total assets, which include cash, property, equipment, and investment. PepsiCo's total assets grew from $92.92 billion in 2020 to $100.5 billion in 2023. Coca-Cola's total assets increased from $87.3 billion in 2020 to $97.7 billion in 2023. Although PepsiCo remains the larger company in terms of total assets, Coca-Cola assets growth rate is slightly higher, meaning it making steady investment to expand its business. Now, total liabilities. PepsiCo's liabilities increased from $79.37 billion in 2020 to $81.86 billion in 2023. Coca-Cola's liabilities grew from $66 billion in 2020 to $70.2 billion in 2023. PepsiCo takes on more debt to expand aggressively, while Coca-Cola follows a more conservative financial strategy. Shareholder equity. Shareholder equity represents the net value of a company available to investors. Coca-Cola's equity rose from $21.28 billion in 2020 to $27.48 billion in 2023. PepsiCo's equity increased from $13.55 billion in 2020 to $18.64 billion in 2023. Coca-Cola has stronger financial position with higher equity, making it more stable investment for shareholders. Operating cash flow. Now let's move into cash flow statement. Operating cash flow shows how much money a company generates from its core business activity. PepsiCo's operating cash flow increased from $10.6 billion in 2020 to $12.8 billion in 2023. Coca-Cola's operating cash flow grew from $9.8 billion in 2020 to $11.9 billion in 2023. PepsiCo's cash flow are higher mainly because of its broader product portfolio. Investing cash flow. Investing cash flow shows how much money a company spent on buying new assets or expanding its business. PepsiCo spent between $4.2 billion to $5.5 billion on investment during this period. Coca-Cola invest range from $2.9 billion to $3.8 billion. PepsiCo invests more aggressively, while Coca-Cola is more cautious. Financial cash flow. Financial cash flow includes activities like borrowing money or paying dividend to shareholders. PepsiCo's financial cash flow was between $6.8 billion to $7 billion, balancing reinvestment with shareholder returns. Coca-Cola financial cash flow ranged from $6.1 billion to $7.2 billion, focusing more on steady dividends for investors. To summarize, PepsiCo earned higher revenue and invest heavily in expansion. Coca-Cola is more profitable related to revenue and maintain a stable financial structure. PepsiCo takes more financial risk with aggressive growth strategies. Coca-Cola follows a conservative approach, focusing on steady returns to investors. Both companies are growing, but they have different strategies. PepsiCo prioritizes expansion, while Coca-Cola focuses on profitability and stability. Now let's move on to financial ratio analysis. Next slide. A company financial health is assessed using key financial ratios across four categories: profitability, liquidity, efficiency, and leverage. These metrics provide insight to earning performance, short-term financial stability, operational effectiveness, and long-term financial growth. First one, profitability ratios. Profitability ratios measures a company's ability to generate profit relative to revenue, assets, or equity. A higher profitability ratio indicates stronger earning efficiency. Key ratios are gross profit margin is equal to revenue minus cost of goods sold divided by revenue. Net profit margin is equal to net income divided by revenue. Net return of equity is equal to net income divided by shareholders' equity. Return of assets is equal to income divided by total assets. Higher value indicates better profitability and financial performance. Second one, liquidity ratio. Short-term liquidity ratios assess a company's ability to meet short-term obligations and maintain financial stability. Strong liquidity ensures smooth operation without financial distress. Key ratios. Current ratios is equal to current assets divided by current liabilities. Quick ratio. Current assets minus inventory divided by current liabilities. Cash ratio is equal to cash divided by current liabilities. Higher value indicates stronger short-term financial stability. Now, third one, efficiency ratios. Efficiency ratios are evaluate how effectively a company utilizes its assets and liabilities to generate revenue. A well-optimized companies maximize return on resources. Key ratios. Inventory turnover is equal to cost of goods sold and divided by average inventory. Accounts receivable turnover is equal to revenue divided by average account receivable. Asset turnover ratio is equal to revenue divided by total assets. Higher value indicates better resource utilization and operational efficiency. And fourth one, leverage ratio. Leverage ratios determine a company's reliance on debt and its financial risk exposure. This ratio indicates the ability to manage long-term obligations. Key ratios. Debt to equity ratio is equal to total debt divided by shareholders' equity. Debt to asset ratio is equal to total debt divided by total assets. Interest cover ratio, earning before interest and taxes divided by interest expense. Lower debt ratios and higher interest coverage indicate stronger financial stability. Now the next part will explain with Garima. Thank you.
Next slide, please. Thanks, Aneesh. So let's start with profitability analysis. As explained by Aneesh, profitability ratios help us evaluate a company's ability to generate profits relative to its revenue, assets, and equity. In this analysis, we will focus on five key ratios: gross profit margin, operating profit margin, net profit margin, return on assets, and return on equity. These ratios help us understand how efficiently PepsiCo and Coca-Cola convert their revenues into profits. So, firstly, we'll discuss gross profit margin. Next slide, please. Gross profit margin measures how efficiently a company produces goods while controlling its production costs. The higher the margin, the better the company is at managing costs and maintaining profitability. To calculate gross profit margin, we use the formula of revenue minus cost of goods sold divided by the revenue of the company. Now, as we can see in the slide, PepsiCo's gross profit margin in 2023 is 54.2%, while Coca-Cola's is 59.6%. Coca-Cola outperforms PepsiCo and is also in line with the industry benchmark of 50 to 60%. The gross profit margin graph suggests that Coca-Cola has a higher margin than PepsiCo, and hence Coca-Cola has stronger pricing power and better cost management in its beverage production. Moving on to the next slide, we'll discuss operating profit margin. Operating profit margin shows how much profit remains after covering operating expenses. A higher percentage means better operational efficiency. And the formula for this is operating profit margin equals to operating income divided by the revenue of the company. Here in the slide, in the given graph, we can see that PepsiCo has an operating profit margin of 13.1%, while Coca-Cola has a significantly higher margin of 25.9%. Coca-Cola's margin is well above the industry average of 15 to 20%, indicating a strong operational efficiency and cost control. PepsiCo's lower margin could be due to its diversified portfolio, which includes snacks and other non beverage items with different cost structures. Now, the next slide, net profit margin. Net profit margin represents the percentage of revenue that becomes profit after all expenses, including taxes and interest. As mentioned in the slide, its formula is net profit margin equals to net income of the company divides by its revenue. The graph suggests that PepsiCo has a net profit margin of 9.9%, while Coca Cola leads with 21%. Coca Cola is well within the industry range of 10 to 20%, whereas PepsiCo is slightly below the average. This suggests that Coca Cola is more effective at controlling costs across its entire operation. So we conclude that Coca Cola leads in this metric as well, showing stronger overall profitability. So we'll discuss return on assets. Return on assets or ROA measures how efficiently a company uses its assets to generate profits. Its formula is net income of the company divided by its average total assets. The ROA graph shows that PepsiCo's ROA is 6.8%, while Coca Cola's is slightly higher at 7.2%. Both companies are within the industry benchmark of 6 to 7%, indicating that they are efficiently utilizing their assets to generate income. The small difference suggests that both companies maintain a similar level of efficiency when managing their total asset base, but Coca Cola uses its assets more effectively than PepsiCo, which is reflected in the higher ROI. Now we'll discuss return on equity. Next slide. Return on equity shows how effectively a company generates profits from shareholders' equity. A higher ROE indicates better returns for investors. To calculate ROE of a company, we use the given formula, that is, ROE equals to net income divided by shareholders' equity. The return on equity graph shows that PepsiCo's ROE is an impressive 51%, while Coca Cola's is 39.3%. Both companies are performing well above the industry average of 30 to 35%. PepsiCo's higher ROE suggests it is generating more profits relative to its equity, likely due to a higher level of financial leverage. Now, comparing all the profitability ratios, we'll see that profitability of both companies, we conclude Coca-Cola outperforms PepsiCo in most profitability metrics, including gross profit margin, operating profit margin, and ROA. However, PepsiCo has a much stronger ROE, indicating high returns for its shareholders. Both companies maintain strong net profit margins, making them competitive in the industry. Now let's begin with liquidity analysis. Liquidity ratios measure a company's ability to meet its short term obligations. The three key ratios that we are going to examine are current ratio, quick ratio, and cash ratio. These ratios will provide insights into how well PepsiCo and Coca-Cola manage their short-term financial stability. So firstly, we are going to discuss current ratio. The current ratio indicates a company's ability to pay off short term liabilities with its short term assets. Its formula is current ratio equals to current assets divided by current liabilities. As we can see from the graph, PepsiCo's current ratio is 0.85, while Coca Cola's is 1.13. The industry average is around 1.1 to 1.2, meaning Coca Cola is in line with industry standards, while PepsiCo falls slightly below. A lower ratio for PepsiCo suggests it may rely more on short term financing to cover its obligations. Next is quick ratio. The quick ratio provides a stricter measure of liquidity by excluding inventory from current assets. So, to calculate it, we use the formula quick ratio equals to current assets minus inventory divided by the current liabilities. As we can see, the graph indicates that PepsiCo has a quick ratio of 0.68, while Coca Cola's is higher at 0.94. The industry benchmark is zero point 0.9 to 1.0, meaning Coca Cola is well within standard, while PepsiCo is slightly below. This indicates Coca Cola has a stronger ability to meet its immediate obligations without relying on inventory sales. Now, moving on to the next slide. Okay, so cash ratio. The cash ratio is the most conservative liquidity measure as it only considers cash and cash equivalents. To calculate it, we can divide company's cash and cash equivalents by its current liability. The graph suggests that PepsiCo has a cash ratio of 0.31, while Coca-Cola's is slightly higher at 0.39. Both companies are performing well within the industry benchmark of zero point 0.2 to zero point 0.3, suggesting they have a strong cash position to cover short term liabilities. A higher cash ratio means Coca Cola has a slightly better ability than PepsiCo to meet its immediate obligations using only its cash and cash equivalents. Now, liquidity comparison. Next slide. Overall, Coca Cola has a stronger liquidity position than PepsiCo across all three metrics, while both companies operate within industry benchmarks. Coca Cola maintains a higher ability to meet short term obligations. PepsiCo's slightly lower ratios suggest it may be leveraging its resources differently, possibly to invest in expansion or product development. So, in conclusion, Coca Cola outperforms PepsiCo in both profitability and liquidity. So, thank you all for your attention. I hope my presentation provided valuable insights into the financial performance of these two industry leaders. Now, I'll hand it over to Kishore, who will guide you through efficiency and leverage analysis.
Yeah, thank you for Garima. It will be covering a grateful those two topics. And now let's we take into the efficiency analysis. Okay, change the slide. Yeah, basically efficiency analysis can be three types of variance it will be analysis: ratio analysis, asset turnover ratios, inventory turnover ratios, and account receivable turnover ratios. What is mean by the asset turnover ratios? Basically, the asset turnover ratios are covered into the measures of how efficiency company changing the generated sales calculated by the divided of net sales average. For an example, can you please change the slide? Yeah, second one. Yeah. For an example, the Coca-Cola and Pepsi is combined if the both ratio analyzing was 0.031 and 0.039. This formula is calculated from the net sales and average sales assets. For an example, how the measures company using the generated sales also, it will be covered utilization, the suggestions, and the Pepsi is a more higher typically indicates the utilizations compared to the Coca-Cola, possibly due to the better operational efficiency, the higher product demands. And then second one, inventory turnover ratio. In the next, the inventory turnover ratio tell us the how efficiency company manage the offense sold and replaced within the year. For an example, if there is a Coca-Cola launches the 100 ml or 1000 ml of the liters, the how the Pepsi also launched the same ratio of is equal to 2023. It's a 7.98 average leverage of the ratios inventories. For an example, turnover ratio is 4.0, while the Pepsi was a significantly higher than 7.98, and then 4 times it's higher than the turnover. For generally favorable to the indicates better inventory analysis and the compared to a Coca-Cola. And then third one, accounts relatable turnover. The third one, yeah, evaluates how efficiency companies receivable the turnovers. For an example, it's everything it's a credit sales only. So the formula is net credit divided into the average account receivables. In 2023, the Coca-Cola had a much higher turnover of the 13.49 compared to the Pepsi. 2.02 is the Coca-Cola. And the collective is receivable more frequently within a year. In the significance of the strong credit policies also, it will be covered in the management, how it is utilizing the lower ratios and will be the more relaxed policies as collections. Throughout the meaning of the companies, too strict and the credit potentials limiting sales opportunities. And those analysis, Coca-Cola is a little higher ratios of the industry in 13.49 margin capacity of the net credit sales. And then the final of the leverage analysis and the efficiency comparisons. Now let's compare them to the efficiency ratios, and as we can the graphs physically, Coca-Cola industry have might stronger than the ratio of three different types. And then asset turnover ratio is higher than the Pepsi, and then inventory turnover ratio is higher than the Pepsi, and also account relatable also lower than the Coca-Cola. So these comparison is the industry benchmarks. This is strongly areas and improvement. How the efficiency managing the receivables, and then leverage analysis. Yeah, leverage analysis. This is a type of three types of ratio analysis. Is a debit to the debit ratio. Benchmarks it's in mostly every industry's performances. For number one, debit equality ratios, and two internet interest coverage ratios and debit ratios. Now number one, debit to equality ratio. Change to slide one. Thank you. Debit to equality ratio indicates the proportion of debit and equality used to the finance company's assets. It will be how the finance ways, including in the both company sectors, divided into the shareholders equality. In 2023, the Coca-Cola debit the equality ratio of 1.93 comparison to the Coca-Cola, and then it's slightly higher than the Pepsi, and also relieves more debit financial ratio. High ratio indicates the aggressive growth, unstraight, but also financially stability without expensive debit dependence. These more margins of the formula of debit equality ratios and total debit equal to shareholder equality. Shareholder is mostly needed for the every industry of sectors. It only the company showing how the industry was growing up and growing down. And the second one, interest coverage ratio. Yeah, interest coverage ratio. For an example, a shareholder was not invest for only a particular money to the capital industry, because they need at least for an interest charges for the how they putting the economic wise in the companies. For both companies of the sectors, earning the before interest and taxes, EBIT, interest and expenses. And also in 2023, the unavailable of both companies, however, generally speaking, the higher ratio indicates for then positioned to cover interest obligations. If either company has a low ratio, it might indicate financial stress and expensive debit burdens. For an example, due to the unavailability of specific data and detailed analysis cannot be provided. For an example, if the interest was slightly low, the shareholders will be there moved on to the other companies and invested the huge amount to get back the high interest ratio coverages. So that's why the shareholder is must for the every industry benchmarkers. And then the third one, debit ratio. The debit ratio indicates the proportion of the company assets, how the financial by year reflection of overall leverages. How can I explain this? Every industry have the some assets of having it's a movable asset and non-movable asset. If movable asset means how the machineries are using, or some other means it is a movable asset. Non-movable assets is a, some of the shares will be the holding. So for an example, if the both companies are every year they are growing aggressively and indicates the positions to leading into the market areas, sectors. For an example, in 2023, Coca-Cola and Pepsi both are having the 41 percentages of the share assets. So these will be slightly more than the Pepsi. So that's total debit and total assets. For both companies have a moderate debit ratios with Pepsi also slightly more leveraged than Coca-Cola. For an example, the conclusion of the both of the analyses for the leverage comparisons of while competing the leverages, Pepsi and Coca-Cola both are equal in the sectors and taking the increase of the financial risk and growing in the industry market sectors also. For the financial structures, investors and shareholders and their assets and everything included to the Pepsi and both Coca-Cola to non-movable to the any other sectors to summarize the outer performance of the leverage sites. And thank you for this opportunity to the. And now slightly go to the next slide to the Sonu.
Oh, hello everyone. So I'll be explaining trend and analysis over time. So Pratik, can you go to the next slide, please? Okay, so this slide contains table comparison of financial performance and ratios over time between the time period for 2022 and 2024. Pratik, can you go to the next slide, please? So here we'll go in depth for the table comparison we had seen earlier. So the first point is revenue growth trends. For Coca-Cola, steady revenue growth due to price adjustments and increased global demand. Revenue increased from $42.3 billion in 2022 to $47.2 billion in 2024, reflecting a compound annual growth rate of 5.6%. Growth driven by expansion in emerging markets such as India, Latin America, and premium product pricing. For PepsiCo, revenue growth has fluctuated due to changing consumer preferences and cost pressures. Revenue rose from $86.4 billion in 2022 to $92.7 billion in 2024, but growth slowed in 2024 due to weakened US demand and inflationary cost increases. PepsiCo's reliance on the snack food segment provided some reliances. Second one, profitability and margin trends. For Coca-Cola, operating margin increased from 25.5% in 2022 to 26.3% in 2024, showcasing operational efficiency. Gross profit margin increased from 58% in 2022 to 58.5% in 2024, benefiting from premium pricing strategies and cost management. such as for PepsiCo, operating margin increased from 13.5% in 2022 to 14.1% in 2024, showing moderate improvement. Gross profit margin improved from 53.5% to 54.1%, but higher cost of goods sold impacted overall profitability. Higher operating expenses due to raw material price fluctuation and logistic costs. Third point, return on equity and financial efficiency. For Coca-Cola, return on equity increased from 37.2% in 2022 to 39.3% in 2024, including better capital efficiency. Free cash flow margin consistently strong at 21.7% in 2024, highlighting efficient cash generation. For PepsiCo, ROE increased from 49.2% in 2020 to 51% in 2024, showcasing strong shareholder returns. Free cash flow margin 7.9% in 2024, significantly lower than Coca-Cola's, indicating high reinvestment in expansion and product innovation. Fourth point, market strategy and product innovation. For Coca-Cola, expansion of Coke Zero sugar driving an 11% increase in global sales, strengthened strategic partnerships with fast food chains like McDonald's to boost sales. For PepsiCo, increased investment in health-conscious products, expanding brands like Gatorade, Naked Juice, and Lay's Baked. Focus on affordable snacking options like Chester's to address price-sensitive markets. Fifth, macroeconomic and market challenges. For Coca-Cola, faced consumer boycotts in Muslim-majority countries impacting local sales, managed inflation pressures by leveraging premium pricing and brand loyalty. For PepsiCo, impacted by rising raw material costs, especially for snacks and beverages. Shift in US consumer demand towards healthier alternative affected to traditional soft drink sales. Pratik, can you move to the next slide, please? Uh, yeah. This slide contains a visual representation of financial trends for Coca-Cola and PepsiCo, provides key insights into revenue growth, profitability, and financial efficiency. Below is a detailed analysis of the trends. So we'll start. First point is for revenue growth trends. So Coca-Cola demonstrates steady growth from $42.3 billion in 2022 to $47.2 billion in 2024. Growth is driven by international market expansion, premium pricing strategies, and increasing demand for non-carbonated beverages. For PepsiCo, shows consistent but slowing revenue growth, rising from $86.4 billion in 2022 to $92.7 billion in 2024. PepsiCo's diversified portfolio contributes to revenue stability, but soda consumption is slowing in mature markets. In 2024, revenue growth declined by minus 1.5%, possibly due to weaker demand in North America. Second, profitability and operating margin trends. For Coca-Cola maintains higher operating margin, that is minus 26%, indicating strong cost control and pricing power. Margins have improved slightly from 25% in 2022 to 26.3% in 2024, suggesting operational efficiency and effective cost management. For PepsiCo, lower operational margins, that is 14% compared to Coca-Cola's, mainly due to higher operational expenses in R&D and logistics. Margins increased from 13.5% in 2022 to 14.1% in 2024, reflecting cost-saving measures and efficiency improvement. Third, return on equity trends. For Coca-Cola, steady increase in ROE from 37.2% in 2022 to 39.3% in 2024, indicating strong shareholder returns. ROE growth suggests effective capital allocation and profitability improvement. For PepsiCo, ROE remains significantly higher, 51%, reflecting stronger capital utilization efficiency. Despite higher reinvestment in business operations, PepsiCo maintains higher profitability relative to equity. Fourth, key patterns and market adoption. Coca-Cola investing in sugar-free and non-carbonated beverages to adapt to changing consumer preferences, strengthening partnership with fast food chains to sustain sales, and PepsiCo increasing focus on health-conscious snacks and affordability-based product expansions, higher investment in product R&D, leading to lower free cash flow but potential long-term growth. So, in conclusion, Coca-Cola is focusing on premiumization and global expansion, while PepsiCo is diversifying its product portfolio to sustain demand. Both companies are adapting to changing consumer preferences, but Coca-Cola has an advantage in operational efficiency, while PepsiCo is positioned for long-term growth and through diversification. Can we move to the next slide, please? So overall comparison and key insights. So this slide comparing the strengths and weaknesses of Coca-Cola with Pepsi. So we'll start with first point: brand strength and market presence. Coca-Cola, stronger global brand recognition with a presence in over 200 countries and a more iconic status. Pepsi, stronger in North America, diversified beyond beverages, giving it a competitive edge. Weakness: Coca-Cola is more reliant on beverages, while Pepsi's broader portfolio increased stability but also complexity. Second, product portfolio and innovation. Coca-Cola is more focused on beverages, leading in carbonated drinks, but slower in adapting to health-conscious drinks. Pepsi, a wider range of products, including snacks, allowing it to capture multiple consumer segments. Weakness: Pepsi's reliance on its snack division for growth, whereas Coca-Cola struggle with innovation outside its core drinks. Third, financial performance and market adaptability. Coca-Cola higher profitability margins due to brand loyalty and strong distribution networks. For Pepsi, higher total revenue due to diversified products, making it less vulnerable to declining soda sales. So if we talk about weakness, Coca-Cola faces challenges adapting to changing consumer preferences, while Pepsi has higher operational costs. Can we move to the next slide, please? So here is the table comparing the financial strengths Coca-Cola versus PepsiCo based on key financial metrics. So for total revenue, in comparison, PepsiCo has a higher revenue due to its diversified portfolio. In net income, PepsiCo has a higher net income, but Coca-Cola has a better margin. For gross profit margin, Coca-Cola is more efficient in pricing and production. In net profit margin, Coca-Cola is significantly more profitable. In market capitalization, Coca-Cola holds a slightly higher market cap. And in debt to equity ratio, Coca-Cola has a more stable balance sheet with less debt. So, can we move to the next slide? Okay. Oh, no, sorry. Can we go to the previous slide? Okay. So, revenue and net income. PepsiCo in quarter 2 2024 reported total revenue of $22.5 billion and net income of $3.8 billion, reflecting its diversified portfolio across beverages and snacks. Such as for Coca-Cola, in the same quarter achieved total revenue of $12.36 billion and a net income of $2.41 billion, focusing primarily on beverages. Second point, profitability and margins. Gross profit margin, Coca-Cola maintains a higher gross profit margin of approximately 61% compared to PepsiCo's 56%, indicating more efficient production and pricing strategies in its core beverage segment. Net profit margin in 2021, Coca-Cola's net profit margin was 25.36%, significantly higher than PepsiCo's 9.66%, showcasing superior profitability. Third, market capitalization and financial stability. Market capitalization. As of 2023, Coca-Cola's market capitalization stood at $24.3 billion, $243 billion, slightly ahead of PepsiCo's $220 billion, reflecting strong investor confidence. Debt to equity ratio, Coca-Cola's ratio of 1.93 indicates a more conservative approach to leveraging compared to PepsiCo's 2.33, suggesting Coca-Cola has a stronger balance sheet. Can we move to the next slide? Okay. So, future outlook based on financial ratio trends. So, first, profitability trend. In that gross profit margin, Coca-Cola maintains a robust gross margin of approximately 58.25%, reflecting strong pricing power and cost efficiency. PepsiCo slightly lower gross margin at 53.58%, indicating higher production cost relative to revenue. Net profit margin for Coca-Cola achieves a net margin of 23.81%, showcasing superior profitability. PepsiCo records a net margin of 8.76%, suggesting room for improvement in cost management. Future implication: Coca-Cola's higher profitability margin position it well to reinvest in innovation and market expansion. Liquidity and solvency. Current ratio: Coca-Cola holds a current ratio of 1.14, indicating a comfortable ability to cover short-term liabilities. For PepsiCo, lower current ratio at 0.88%, suggesting tighter short-term liquidity. Debt to equity ratio: Coca-Cola exhibits a debt to equity ratio of 1.93, reflecting a balanced approach to leveraging. PepsiCo's higher ratio at 2.33, implying greater resilience on debt financing. Future implication: Coca-Cola's stronger liquidity and conservative debt levels may provide greater financial flexibility in uncertain economic conditions. Third, operational efficiency. Inventory turnover ratio. Coca-Cola demonstrates an inventory turnover of 8.83, indicating efficient inventory management. PepsiCo, lower turnover at 4.39, suggesting longer inventory holding periods. Total assets turnover. Coca-Cola achieves a ratio of 0.85, showcasing effective utilization of assets to generate revenue, whereas for PepsiCo, records a ratio of 0.42, pointing to potential inefficiencies and assets used. Yes. So the key takeaways are Coca-Cola's superior profitability, liquidity, and operational efficiencies suggest a favorable future outlook, enabling to navigate more challenges effectively, whereas for PepsiCo, higher debt level and professional efficiencies may require strategic adjustments to enhance financial performance and competitiveness. Can we move to the next one? Yeah. Summary of key findings. So the first point is financial strength and performance overview. Coca-Cola demonstrates strong profitability, higher operating margins, and efficient cost management, making it a financially stable company with strong shareholder returns. Whereas for PepsiCo has higher total revenue due to its diversified product portfolio, but lower margin due to higher operational expenses and reinvestments. Second, profitability analysis. For Coca-Cola, higher gross profit margin with 58.5% and operation margin with 26%, showcasing strong pricing power and cost control. For PepsiCo, lower operating margin with 14%, indicating higher production and operating costs, but consistent revenue growth due to product diversification. Third, liquidity and financial stability. For Coca-Cola, strong liquidity position with a higher cash ratio and a free cash flow, ensuring better short-term financial stability. For PepsiCo, lower liquidity but efficient working capital management, reinvesting more into growth and innovation. Efficiency and asset utilization. Coca-Cola, higher asset turnover ratio, meaning better efficiency in generating sales from its assets. PepsiCo, slightly lower efficiency but better inventory and receivable turnover, indicating strong supply chain management. Fifth, leverage and debt management. For Coca-Cola, lower debt to equity ratio, suggesting lower financial risk and better debt management. For PepsiCo, higher leverage but better interest coverage ratio, showing ability to manage its debt obligation effectiveness. Six, trend analysis over time. So for Coca-Cola, consistent revenue growth with 5.6 CAGR, improving margins and a stable ROE with 39%, making it a low risk high profitability company. Whereas for PepsiCo, slower revenue growth with 3% CAGR, but higher ROE 51%, suggesting aggressive reinvestment and growth-oriented strategy. So the final verdict: which company is financially stronger? Coca-Cola is financially stronger in terms of profitability, operational efficiency, and liquidity, making it a safer investment with stable return. Whereas PepsiCo excels in diversification, long-term growth potential, and market adaptability, but it faces higher costs and low margins. Investment perspective: short-term investor, Coca-Cola is more stable and profitable. Long-term investment, PepsiCo has growth potential but requires risk tolerance. Future outlook: so, for Coca-Cola, continued growth in premium and non-carbonated beverages, strong global presence, and a stable dividends make it a longer-term leader. For PepsiCo, higher investment in health-conscious products, expansion into snacks and functional beverages, and the aggressive marketing will drive future market and share growth. Can we move to the next slide? So, final thought for PepsiCo versus Coca-Cola. First, strategic positioning and competitive advantage. For Coca-Cola dominates the beverage industry with a strong brand, high profitability margins, and a superior operational efficiency. Its focus on beverages allows for deep market penetration but limit diversification. For PepsiCo, benefits from a diversified portfolio such as snacks and beverages, leading to higher total revenue. However, low profit margin and higher debt level indicates financial and operational challenges. Overall insight: Coca-Cola has a stronger financial foundation, while PepsiCo diversified strategy helps mitigate risk in a changing market. Second, future outlook and market sustainability. Coca-Cola well positioned for long-term growth due to its strong global brand, efficient cost structure, and adaptability in the health-conscious market. So, whereas for PepsiCo, needs to optimize debt management and operational efficiency while leveraging its broad product range to maintain competitive edge. Final verdict is Coca-Cola excels in profitability and efficiency, while PepsiCo thrives on diversification, making both strong but distinct and market leaders. So, with this, I conclude with my part. Thank you. So, yeah.